Hey everyone, and welcome to the Deep Dive. Today we're diving into something that might seem, well, a little intimidating at first.
Yeah.
Investment portfolios.
Yeah, portfolios can seem kind of scary to a lot of people.
But by the end of this deep dive,
Mm,
I think you'll be feeling a lot more confident about building your own.
definitely. And we're going to be looking at a bunch of the research and articles that you've shared. We'll explore everything from risk tolerance and diversification to, different types of portfolios, real world examples, even how global events might impact your own personal strategy.
Exactly. And we're going to break it all down, in a way that hopefully makes sense.
Make it easy to understand.
Yeah.
And hopefully even a little fun along the way.
Exactly.
Oh, wait.
So let's jump right in.
Let's do it.
When I first started learning about investing, I kind of thought portfolios were only for
Oh, yeah.
those Wall Street,
Big fancy investors.
Yeah, the guys in the suits,
Yeah, with tons of money already.
Yeah, exactly.
Yeah.
And I quickly realized, it's not about that at all. It's about taking control of your financial future,
It is.
no matter how much you're starting with.
Right.
And what's so fascinating to me is that building a portfolio is a lot like putting together a puzzle.
I like that analogy.
Yeah.
I like that.
Each piece or asset class plays a role.
Yeah, you got your stocks, you got your bonds,
Real estate.
maybe some commodities.
There's a gold in there.
Right, exactly.
Right.
It's all about, finding the right pieces that fit your goals and your risk tolerance.
And speaking of risk tolerance, our sources highlighted this really interesting point
Yeah.
about how it changes throughout your life.
Yeah.
Makes
sense, right?
When you're younger, you might be a little more comfortable taking on more risk,
Yeah.
like a basketball player going for a slam dunk.
Yeah, you're younger, you got more time to recover if things don't go your way.
Yeah, exactly.
As you get closer to retirement, though, you might prefer a more conservative approach, like a soccer player protecting their lead, playing more defense.
Okay, so I'm starting to see the bigger picture here.
Okay, good.
But why not just put all your money into the investment with the highest potential return?
Well,
Wouldn't that be the fastest way to grow your wealth?
you're right in thinking that the higher the potential return, the faster you could grow your wealth.
Right.
But that's where diversification comes in.
Okay.
You see, relying on just one investment is super risky. It's like putting all your eggs in one basket.
Right.
If that basket falls, you lose everything.
You're in trouble.
Diversification helps you spread that risk.
Don't put all your eggs in one basket. Classic advice.
Right.
But I get it.
It's so true, though. It really applies here.
Yeah.
So, you don't want to have all your money in one stock or
Yeah.
one type of investment.
Right.
What if that one thing does really poorly?
And we've seen that happen.
Yeah, exactly. And our sources have this compelling historical example.
Right.
Back in the dot-com bubble of the late 90s, many investors poured all their money into tech stocks, and we all know what happened.
Right.
When the bubble burst, those who were overly concentrated in tech suffered huge losses.
Oh, yeah.
But those who had diversified portfolios with a mix of stocks, bonds, other assets, they were able to weather the storm much better.
Yeah, it makes sense.
They didn't lose everything.
Yeah, that's a great example.
Yeah.
It really drives home that importance of diversification.
It does.
But with so many different asset classes to choose from, how do you actually decide how much to allocate to each one?
Right, that's a great question, and that's where asset allocation comes into play.
Okay.
Think of it like designing a game plan for your investments.
Okay, so like percentage-wise.
Yeah, exactly. You need to decide what percentage of your portfolio you want to dedicate to stocks, to bonds, real estate, and so on.
So it's like a coach deciding which players to send onto the field.
Exactly. The right asset allocation for you depends on your risk tolerance, your time horizon, and your financial goals.
Makes sense.
So, for example, a younger investor with a higher risk tolerance might allocate a larger portion of their portfolio to growth stocks,
Okay.
while someone closer to retirement might favor a more conservative approach with a heavier focus on bonds.
So your game plan changes depending on where you are in the game.
Yeah, exactly.
Okay, that makes total sense.
That's a great way to put it.
But this all seems pretty theoretical so far.
Mhm.
Do our sources offer any real-life examples of how this actually works?
Absolutely. One of the sources provides a sample portfolio breakdown for someone in their 30s with a moderate risk tolerance.
Okay.
And this might be particularly relevant for you.
Yeah, that's me.
It might spark some ideas as you think about your own portfolio.
Awesome. Yeah, let's break it down.
Okay, let's do it.
So this sample portfolio allocates 60% to stocks, 30% to bonds, and 10% to cash.
Okay.
What's the rationale behind those percentages?
Well, for someone in their 30s, they have a longer time horizon
Okay.
to ride out market fluctuations.
Right.
So a larger allocation to stocks.
Right.
Uh-huh.
Which have historically offered higher returns over the long term.
Yeah.
Makes sense.
Right.
However, they are also incorporating bonds for diversification
Okay.
and to mitigate some of the volatility that comes with stocks.
So it's all about finding that sweet spot between risk and return.
Precisely. And the 10% allocation to cash
Right.
provides liquidity for short-term needs and acts as a buffer during market downturns.
So if you need to access some money quickly,
Exactly.
you're not,
You're not stuck.
Yeah.
You have some flexibility.
But within that 60% allocated to stocks, this sample portfolio doesn't just lump it all together.
Right.
It breaks it down even further.
Right.
Why is that?
That's another layer of diversification.
I see.
This sample portfolio includes a mix of U.S. large-cap stocks,
Okay.
international stocks,
Okay.
and even a portion dedicated to emerging markets.
Emerging markets.
So this ensures that you're not overly exposed to any single market or sector. So it's like having players from different countries on your team, each bringing their own unique skills to the table.
I like it.
Right.
I like the analogy.
What about the 30% allocated to bonds?
Yeah.
Is that all in one type of bond as well?
Not at all. Even within bonds, you can diversify.
Okay.
The sample portfolio includes a mix of U.S. government bonds,
Okay.
considered to be very safe,
Yeah.
and corporate bonds,
Wow.
which offer a higher potential return,
Right.
but also come with more risk.
Yeah, that makes sense. So it's all about spreading the risk even within each asset class.
Exactly.
Now, all this talk about diversification and allocation makes me think there must be different types of portfolios to achieve different goals.
You're absolutely right. It's not a one-size-fits-all approach.
Right.
Some people are all about growth, while others prioritize a steady stream of income. So we should probably dive into those different types of portfolios.
Yeah,
And you know how they might align with different investor profiles.
that sounds good to me. But before we do that,
Let's do a really quick recap.
yeah, let's recap what we've talked about.
We've covered a lot of ground already.
A lot of info. Yeah.
So we've established that building a portfolio is about taking control of your financial future
Absolutely.
and understanding that it's not just for,
To super wealthy.
yeah, the wealthy. Exactly.
Anyone can do this.
And we've explored these crucial concepts of risk tolerance, recognizing how it evolves throughout life.
Right, you get more conservative.
Yeah, exactly.
Great
As you get older, typically.
And we've highlighted the power of diversification,
Super important.
emphasizing that it's not about avoiding risk,
Yeah.
but about spreading it strategically.
Yeah, you're not going to eliminate risk,
Right.
but you're going to manage it the best you can
Yeah,
so you can, sleep well at night.
exactly. And we even peeked into a real-world example of a portfolio for someone in their 30s, showing how you can allocate assets based on your risk tolerance and time horizon.
Yeah. And that's just one example.
Yep.
There are so many different ways to do this.
Exactly. And that's just the tip of the iceberg.
Mm-hmm.
There's a whole world of portfolio strategies and investment approaches to explore.
We're just getting started.
I can't wait to delve deeper.
Me too.
So stay tuned as we unpack those different types of investment portfolios
All right.
and uncover which ones might be the right fit for you, how they can help you achieve those financial dreams.
Sounds good. So before the break, you were asking about, different types of portfolios.
Yeah.
It's like choosing your team's formation in a sports game.
Right.
You wouldn't use the same strategy for every opponent, right?
Exactly. And in the world of investing, you have different formations or portfolio types to match your financial goals
Right.
and risk appetite.
Makes sense.
Our sources outline a few key ones:
Okay.
growth portfolios, income portfolios, balanced portfolios, and even target date portfolios.
Yeah.
I have to admit those last ones sound intriguing.
They are interesting, especially if you have a specific financial milestone in mind, like retirement.
Right, yeah.
But let's start with growth portfolios.
Okay.
As the name suggests, these are all about maximizing capital appreciation over time.
So for someone who's looking to hit a home run with their investments.
Precisely. Growth portfolios typically have a higher concentration of stocks.
Okay.
Particularly those of companies expected to grow at an above-average rate.
Ah.
They're well-suited for younger investors with a longer time horizon who can tolerate greater market fluctuations
Right.
in pursuit of potentially higher returns.
Okay.
Think of it as playing offense, aiming for those big gains.
Got it. But what about those who prefer a more steady and reliable approach, like focusing on defense
Okay.
to protect their assets?
Yeah, that's where income portfolios come in.
Okay.
These are designed to generate a consistent stream of income through dividends, interest payments,
Okay.
and other distributions.
Good.
They tend to favor bonds, dividend-paying stocks,
Right.
and sometimes real estate. It's about creating a predictable cash flow, perhaps, for someone in retirement
Right.
who relies on their investments for income.
So it's like having a team that consistently scores points even if they're not always hitting home runs.
Exactly. Income portfolios offer stability and a sense of security, particularly for those who prioritize a predictable income stream over rapid growth.
Makes sense. Now, what about those of us who want a bit of both?
Okay.
Is there a portfolio type that balances growth and income?
Absolutely. That's where balanced portfolios come in.
Okay.
These aim to achieve a mix of growth and income
Mm-hmm.
by diversifying across both stocks and bonds.
Okay.
The specific allocation will depend on the individual's risk tolerance and financial goals.
Right.
It's like having a balanced team that can adapt to different game situations.
This is starting to feel like a real playbook for investors.
I like it.
But you mentioned target date portfolios earlier, and I'm still curious about those. What makes them so special?
Target date portfolios are fascinating because they automatically adjust over time
Okay.
based on a specific target date, usually retirement.
Retirement. Okay.
Early on, they might be heavily weighted towards growth stocks.
Uh-huh.
But as you get closer to your target date,
Right.
the allocation gradually shifts to become more conservative,
I see.
increasing the proportion of bonds and decreasing the exposure to stocks.
Wow. So it's like having a coach who automatically adjusts the game plan as the clock winds down.
Precisely. Target date portfolios are designed to simplify investing
Okay.
for those who want a hands-off approach
Right.
and prefer to have their investments automatically adjust
Right.
as they approach their retirement date.
That sounds pretty convenient, but wouldn't that limit your control over your investments?
It's true that you have less direct control over the specific assets within a target date fund.
Okay.
However, you still have the power to choose the target date that aligns with your retirement plans.
Right.
And you can always make adjustments if your circumstances change.
So it's not completely set in stone.
Right.
You still have some flexibility.
You do.
But with so many different portfolio types and strategies to choose from,
Right.
how do you actually decide which one is right for you?
That's where self-reflection and research come into play.
Yep.
Start by asking yourself some key questions. What are your financial goals? When do you need the money? How much risk are you comfortable taking?
So it's like scouting your own team, understanding your strengths and weaknesses before you hit the field.
Exactly. Once you have a clear understanding of your financial landscape, you can start exploring different portfolio options and see which ones align best with your needs and goals.
Okay.
And remember, it's always wise to consult with a financial advisor if you need personalized guidance.
That's a great point. It's like having a coach in your corner who can help you strategize and make the best decisions for your financial game.
Absolutely.
Speaking of coaches, our sources also talk about the importance of regularly monitoring and rebalancing your portfolio.
Yes.
Why is that so crucial?
Well, just like any team, your portfolio needs regular checkups and adjustments. Over time, as some investments perform better than others, the initial asset allocation you set might drift.
Uh-huh.
Rebalancing brings your portfolio back into alignment with your target percentages for each asset class.
So it's like making sure your players are in the right positions and the team is functioning optimally.
Exactly. Rebalancing helps you maintain your desired risk level and stay on track to achieve your financial goals.
Okay, I'm starting to feel a lot more comfortable with this whole portfolio concept.
Good.
But I have a confession. To make the thought of picking individual stocks and bonds still makes me a little nervous.
I understand not everyone enjoys the intricacies of stock picking or bond analysis.
Right.
Fortunately, there are investment vehicles designed to simplify the process.
Oh, tell me more. This sounds right up my alley.
One popular option is mutual funds.
Okay.
These are essentially baskets of stocks, bonds, or other assets managed by professional fund managers.
Okay.
When you invest in a mutual fund, you're instantly diversifying your portfolio across a range of holdings.
So it's like having a team of experts making the investment decisions for you.
Exactly. Mutual funds offer diversification, professional management, and a wide range of investment options to suit different risk tolerances and financial goals.
That sounds a lot less intimidating than trying to pick individual stocks.
It can be.
Are there any other options for someone who prefers a more hands-off approach?
Absolutely. Another popular alternative is exchange-traded funds, or ETFs.
Okay.
These are similar to mutual funds in that they hold a basket of assets, but they trade on stock exchanges like individual stocks.
So you can buy and sell them throughout the trading day, just like you would with a company stock.
Exactly. ETFs offer the diversification benefits of mutual funds with the added flexibility of intraday trading.
This is great. It's like having a team of experts managing your investments, but you still have the freedom to make moves if you want to.
You got it.
But with all these different options, how do you actually choose which mutual funds or ETFs to invest in?
That's where research and due diligence come in. You need to understand the fund's investment objective, its track record, its expense ratio, and how it aligns with your overall investment strategy.
So it's like scouting the other teams before you go head-to-head with them on the field.
Precisely. You want to make sure the mutual funds or ETFs you choose are a good fit for your portfolio and have a track record of success.
Okay, I'm getting the hang of this, but sometimes I hear people talking about these really complex investment strategies. Like hedging and short selling. Is that something I need to worry about when I'm just starting to build my portfolio?
Those are definitely more advanced techniques
Okay.
that are best left to experienced investors.
Gotcha.
When you're starting out, it's best to focus on the fundamentals.
Okay.
Building a diversified portfolio, understanding your risk tolerance, and choosing investments that align with your financial goals.
So stick to the basics and build a strong foundation before trying any fancy footwork.
Exactly. Once you have a solid understanding of the fundamentals, you can always explore more sophisticated strategies later on.
That makes sense. But, we can't talk about investing without addressing the elephant in the room.
Oh, yeah.
Taxes. I know it's not the most exciting topic.
You're not the most fun.
But our sources emphasize its importance.
Absolutely. Taxes can significantly impact your investment returns.
Yeah.
And it's crucial to be mindful of the tax implications of different investment choices.
Okay, so walk me through this. How do taxes affect my investments?
Different types of investment income are taxed differently.
Okay.
For example, interest income from bonds is generally taxed as ordinary income, while long-term capital gains from stocks held for more than a year are taxed at a lower rate.
So it's not just about how much money your investments make, but also how much you get to keep after the tax man takes his cut.
Precisely, and that's where tax-advantaged accounts can be incredibly beneficial.
Ah, yes. Our sources mention those. Can you explain how they work?
Sure, tax-advantaged accounts like IRAs and 401ks offer special tax benefits that can help you accumulate wealth more efficiently.
So they're like getting a tax break for being a responsible investor.
You could say that there are two main types of IRAs, traditional and Roth. With a traditional IRA, your contributions are typically tax deductible, meaning you can reduce your taxable income in the present, and your investments grow tax deferred, meaning you don't pay taxes on your earnings until you withdraw the money in retirement.
So it's like delaying the tax bill until later.
Exactly. With a Roth IRA, your contributions aren't tax deductible.
Okay.
But your withdrawals in retirement are tax-free.
Wow, that sounds pretty appealing. But which type of IRA is better, traditional or Roth?
That depends on your individual circumstances and financial goals.
Okay.
If you expect to be in a lower tax bracket in retirement, a Roth IRA might be more beneficial. But if you're in a higher tax bracket now and anticipate being in a lower bracket later, a traditional IRA might make more sense.
Okay, so it's not a one-size-fits-all answer. You really need to consider your own situation. What about 401ks? How do those work?
A 401k is a retirement savings plan offered by employers.
Okay.
You contribute a portion of your pre-tax salary, and your employer may match a portion of your contributions.
Okay.
Similar to traditional IRAs, your contributions are tax deductible, and your investments grow tax deferred until retirement.
So it's like getting a bonus from your employer to save for retirement.
You could put it that way. It's a powerful way to boost your retirement savings, especially if your employer offers a generous matching contribution.
This is all incredibly valuable information. It's amazing how much goes into building a successful investment portfolio.
It is.
It's not just about picking stocks and hoping for the best.
You're absolutely right. It requires careful planning, a solid understanding of your financial goals, and a willingness to adapt your strategy as circumstances change.
But with the right knowledge and guidance, anyone can build a portfolio that empowers them to achieve their financial dreams.
Absolutely. And remember, it's a journey, not a destination. The world of investing is constantly evolving, so it's important to stay informed and continue learning along the way.
I couldn't agree more. Before we wrap up this segment of our deep dive, I want to circle back to something we touched on earlier. Market volatility. The ups and downs of the market
Yeah,
can be nerve-wracking,
it can.
especially for new investors.
It's true.
So how do you manage those feelings of anxiety and avoid making impulsive decisions
Okay.
when the market gets turbulent?
One of the best ways to navigate market volatility is to have a well-defined investment plan
Oh.
and a long-term perspective.
Right.
It's easy to get caught up in the hype of the moment,
Yeah.
but it's crucial to remember that investing is a marathon, not a sprint.
So it's about keeping your eyes on the prize and not getting sidetracked by short-term fluctuations.
Exactly. Having a clear investment plan helps you stay focused on your goals
Okay.
and avoid making emotional decisions that could derail your progress. And remember, market downturns can actually present opportunities for savvy investors.
Okay.
When prices drop, it can be a good time to buy assets at a discount,
Yeah.
assuming your long-term outlook remains positive.
That's an interesting perspective. It's like a sale at your favorite store.
Yeah.
You can stock up on high-quality items at a lower price.
Precisely. Just be sure to do your research and make informed decisions
Right.
based on your overall investment strategy.
Yeah.
Don't let fear or greed dictate your actions.
Okay, that makes sense. But are there any specific strategies for managing risk in a volatile market besides diversification? Of course, we know that's key.
Okay. One effective strategy is dollar cost averaging.
I've heard that term before, but I'm not entirely sure what it means.
Dollar cost averaging involves investing a fixed amount of money at regular intervals regardless of market conditions.
So it's like setting up a recurring payment for your investments.
Exactly. By investing consistently, you're buying more shares when prices are low and fewer shares when prices are high. This helps you average out your purchase price over time and potentially reduce your overall risk.
That sounds like a smart approach, especially for someone who might be nervous about investing a lump sum all at once.
Exactly. It's a way to ease into the market and mitigate the risk of investing at the wrong time.
Okay, dollar cost averaging. Check any other risk management strategies to keep in mind.
Another strategy is to maintain a cash reserve.
Okay.
Having a portion of your portfolio in cash or cash equivalents like money market funds can provide a cushion during market downturns and give you the flexibility to invest when opportunities arise.
So it's like having a financial safety net
Precisely.
in case things get bumpy.
It's all about managing risk
Okay.
and positioning yourself for long-term success.
This deep dive has been incredibly insightful. We've covered so much ground,
Yeah, it has been a lot.
from the basics of investment portfolios to advanced risk management strategies. I feel like I've learned a whole new language.
It's been quite a journey, hasn't it?
It has.
We've explored the key components of a well-rounded portfolio, the importance of diversification,
Right.
the different types of investment vehicles available.
We've also discussed the significance of risk tolerance asset allocation and the need for regular monitoring and rebalancing.
Uh-huh.
And we've delved into the tax implications of different investments,
Yeah.
the benefits of tax-advantaged accounts,
Yep.
and the importance of maintaining a long-term perspective
Absolutely.
in the face of market volatility.
It's a lot.
It's been a comprehensive exploration
It has.
of the world of investment portfolios, wouldn't you say?
Absolutely. We've covered a vast amount of information, but I think it's important to remember that building an investment portfolio is a personalized journey.
Yeah.
There's no one-size-fits-all approach, and what works for one person might not work for another.
That's why it's so important to do your research, understand your financial goals,
Yes.
and seek guidance from a trusted financial advisor if needed.
Absolutely.
And remember, investing is a lifelong learning process. The more you learn, the more confident and informed you'll become as an investor.
That's a great reminder.
Investing is not a destination. It's a continuous journey of learning, adapting, and growing your financial knowledge and wealth.
I like that.
Before we move on to our final thoughts and takeaways, let's take a quick pause to let all of this information sink in.
Sounds good.
All right, so welcome back to the deep dive. We've covered so much on investment portfolios.
We have.
And I feel like I'm way more equipped to actually tackle my own financial future.
Good.
But before we wrap things up,
Okay.
I want to revisit that thought-provoking question you kind of posed earlier about global events.
You're referring to how current events can impact your investment strategy.
Yeah.
It's a critical consideration because the world's always changing, right?
Right.
And those changes can create both risks and opportunities for investors.
Exactly. It's like the playing field is always shifting, and we need to adjust our game plan accordingly.
I like it.
So can you give me some real-world examples of how global events might impact someone's portfolio?
Sure. Let's say you're heavily invested in companies that rely on international trade.
Okay.
A sudden trade war between major economies could disrupt supply chains, increase costs, and potentially hurt those companies' profits.
Right.
And that could, in turn, negatively impact your portfolio.
So it's like having a star player get sidelined with an unexpected injury.
Exactly. It can throw off your whole game.
Right.
On the flip side, let's imagine you've invested in companies focused on renewable energy solutions.
Okay.
A global push towards sustainability driven by government policies and consumer demand
Right.
could create a boom in that sector,
Uh-huh.
potentially leading to significant gains in your portfolio.
So it's not all doom and gloom.
Right.
Global events can create opportunities as well.
Yeah, exactly.
But how can investors kind of stay informed and make those adjustments to their portfolios as needed?
Yeah, that's a great question.
It's like trying to predict the weather.
Staying informed is definitely key.
Okay.
Reading financial news, following market trends. Subscribing to reputable investment newsletters can all help you stay ahead of the curve.
Right.
And remember, it's not about predicting the future with certainty.
Right.
It's about being aware of those potential risks and opportunities.
Yeah.
So you can adapt your strategy as needed.
So it's like having a scouting team that keeps you updated on the latest developments
Yeah, I like that analogy.
and helps you anticipate potential challenges or opportunities.
Yeah, that's a great way to put it.
Speaking of scouting teams,
Right?
I'm curious to know, are there any specific strategies for mitigating that risk
Yeah.
in a world where, global events can throw curveballs at any moment?
Diversification is always your best defense against unforeseen events.
Of course. Right.
By spreading your investments across different asset classes, sectors, and geographical region, you're less exposed to the risks associated with any single event or trend.
So it's like having a team with players who can excel in different conditions.
Yeah, exactly.
So no matter what challenge, the game throws your way,
Yeah.
you're ready.
You're prepared.
Exactly.
Building a resilient investment portfolio is all about anticipating and adapting to change.
This has been an incredible deep dive, and I feel like we've given our listeners the knowledge and tools to navigate the exciting world of investing.
Yeah, I think we've covered a lot of good information.
Yeah, we demystified complex concepts, broke down the jargon.
Language of investing.
Yep.
It can be very jargony.
And provided practical insights that can help anyone, regardless of their background, really build a portfolio that aligns with their goals.
Yeah, I hope so.
But before we say goodbye,
Okay.
what's that one key takeaway you hope our listener will remember long after they finish listening?
I'd say the most important takeaway is this. Building a successful investment portfolio is a personalized journey.
Yeah.
There's no one-size-fits-all approach.
Right.
What matters most is understanding your financial goals, your risk tolerance,
Uh,
and then crafting a strategy that aligns with your unique needs and aspirations.
I love that. It's all about taking control of your financial future and making those informed decisions that empower you to achieve your dreams.
That's it.
So to our listener, we encourage you to keep learning, keep exploring, keep growing that financial literacy.
Absolutely.
Investing is a lifelong learning process. The more you learn, the more confident and informed you'll become as an investor.
Remember, investing is a marathon, not a sprint. Stay informed, stay disciplined, and stay focused on those long-term goals.
Okay.
And most importantly, enjoy the journey.
That's a wrap on our deep dive into investment portfolios. We hope you found this exploration informative and empowering.
Yes.
Until next time, keep diving deep and keep seeking knowledge.
Sounds good.